Okay, welcome everybody. July 1st. We've been doing these for several months now, and thank you for joining us. As usual, you're welcome to email me questions if you have them, or ask at the end. So I am going to kick right off. I hope you're all well. I hope your families are well. I hope you're enduring this and not too bored or too stir crazy at home. I like the timing of this call because it is officially the end of the quarter. One of I think what will go down in my history as one of the two most hellacious quarters that I've experienced. There was a big Wall Street Journal headline yesterday that came out at like 4:02, and it said biggest quarter since 1998 or best highest quarter since 1998. And I thought, whoopee, what a lousy endorsement that is for a great quarter. So anyway, one of the things that I wanted to mention is that, as Dr. Scott Gottlieb reminded us in some commentary last week, this is but a brief moment in our long history. And what I'd like to remind you, I'm going to share my screen to do this. Hang on for one sec, I have this teed up. What I'd like to remind you is that, okay, hopefully you can all see my screen right now, is that there has never been a bear market in history that we haven't recovered from. And what I put up on the screen is the stock market since 1900, so the past 120 years. And hopefully you can all see this. I'm happy to email it to you, to those of you who are on the phone, but it shows everything from World War I to the Great Depression to World War II, the Korean War, Vietnam War, Reagan era, Black Monday. We've never not recovered from a bear market. So as we continue to fight our way back to even in your portfolios, please remember that it's not a question of if, it's just a question of when, and we will get there. So, okay. So with the quarter just ending, we had a really, not only the S&P had a big quarter, we had a really big quarter too. Our income and growth strategies outperformed the S&P, thank goodness. Our international strategy had a really strong performance too, and performed right in line with its benchmark. The U.S. dividend portfolio and the growth portfolio were both up over 20% during the quarter, and the international portfolio was up 15%. So we're still down a bit on the year. We're down a lot on the year, but we've made up a lot of that lost ground. We're working on the quarterly letter right now, so this is going to be your sneak peek to what's in that quarterly letter. And then when you read it, it may be redundant. So if it is, hi Elena. So if it is redundant, I apologize for that, but hopefully the letter will be more robust than the call. As we've been working on the letter, we've thought a lot about our favorite Harvard professor of psychology, a guy named Steven Pinker. He did a really terrific TED Talk about, I don't know, maybe a couple years ago. And he asked maybe within the last 2 years though. And he asks the question, is the world getting better or worse? Let's look at the data. And it's so easy. When he did this TED Talk, it was before any of this had started. But it's so easy to say the world's getting worse. And it's so easy, particularly right now, not only for the world, but for the portfolio and for the market, especially as we're seeing virus cases increase and spike since our last call to you. It's so easy to think that the world's getting worse. So what we wanted to do is we wanted to actually look at the data and see what that looks like and see what's happened. One of the things is that as we see the reversals of reopening, we don't want to get too draconian, and we don't want to see these like huge spikes and think that it has a major impact for the economy, because it may not, and it's not going to be a total shutdown, and it may not be a shutdown of the Northeast, which has a huge percent of the overall GDP. So I'm going to get into the data on that. Greg and I are going to get into the data on this. Greg, do you want to just touch on, as we see the reversals of openings, what the bars and restaurants impact is on that?
Yeah, as of now, it seems like the biggest target for reversing for the reopening of the economy and reversing that is the bars and restaurants, is seen as a large contributor to the outbreak. But it's also a fairly small part of the economy. Just to put some perspective on how significant spending at bars and restaurants are, last month in May, retail sales at bars and restaurants was about $40 billion. So 8% of total consumer spending. But that includes a lot. There's fast food, there's takeout, there's standalone bars, standalone restaurants, and there's a lot in that category. So if the shutdown targets that $40 billion of spending, it shouldn't be enough to derail the economic recovery that's going on. And just some perspective on relative to how big that is. In May alone, the increase in spending on autos was $35 billion. Online retailers, their sales were up $7 billion last month and up $16 billion compared to the year before. So that shutting down restaurants and bars shouldn't be too scary in terms of the economic impact.
Right. Okay. So with the economic impact, I'm going to give you the punchline first. And the punchline is that trends are improving. And economics, as we all know, is all about trends. We're not back to where we were in the PCE, which is my new thing for pre-corona era. We're not back to where we were, but it's improving. So I'm just going to run you through some of those. We'll start with initial jobless claims, which peaked on March 28th at initial claims of 6.9 million for the week, and then fell for the following 12 straight weeks. Since March, 47.3 million people have filed for unemployment. However, continuing claims right now are 19.5 million. That's still a huge number, but it means that a ton of people have gone back to work and have been rehired. The unemployment rate, which when this all began, was hovering at below 4%, and then rose to about 4.5% in March, then went up to 14.7% unemployment in April. Now it's at 13.3. Again, 13.3 is really high, but we need to look at the trends, and the trends are that these are improving. Oil, you may remember from 6 calls ago, when the price of oil actually went into negative $40 a barrel range. So oil started the year at almost $60 a barrel. By the beginning of this quarter, April 1st, it was trading at $20 a barrel. It went crazy because of trading disruptions, went down to negative $40 a barrel, which means people are paying someone $40 to take a barrel of oil off their hands. And now we're at a normal price. We're at $40 a barrel, which means the companies that produce oil are profitable. It means that the supply-demand balance is returning. You've seen gasoline demand really start to pick up again. It's almost at normal levels from a year ago. So again, it's the trend and it's normalization that we're looking at. Auto sales went from an average, they measure this in seasonally adjusted annual rate of sales. So prior to the coronavirus, we were trending for about 18 million vehicles sold a year. That dropped to a low of 8 million, but it's already back to just shy of 13 million. So that's really on the mend. Retail sales, so just normal buying of stuff, saw its largest ever monthly drop in April. It dropped by 14.7%. They measure this month to month. That's never happened before. And now it's rebounded by about 17.5% from April to May. So we expect that trend of improvement will happen. Again, we're nowhere near the pre-coronavirus levels, but all of these trends are improving. And even as states halt their reopening or reverse some reopening, I don't think that we're going to see anything that looks like the shutdown in March and the total reversal of these trends. Then maybe they slow, maybe an improvement slows, but I think that we're on a path to recovery. The same is true for the virus and the trends with the virus. So Greg, can you touch on that?
Yeah, I think there's been a great improvement in the virus, the spread of the virus in the U.S. throughout the quarter. Although I will highlight that first, that in the last 2 weeks, we have seen the number of cases of the virus each day has doubled over the past 2 weeks. And I just want to say it's not as bad as it feels, and don't let that overshadow how much progress has been made in the last 3 months. So to look back, and when writing the letter, we looked back at how things were at the beginning of the quarter, and it seemed so long ago. And but at the start of the quarter, we were 2 weeks into the shutdown. We had no idea when that shutdown would end. Cases and deaths were spiking. Here in New York, the Jacob Javits Convention Center was converted into a makeshift COVID hospital. The federal government had sent up the USS Comfort ship to help with dealing with the virus in New York. So things were really bad. I think we forget how bad things were just 3 months ago. We were only testing 100,000 people a day. We only had capacity to test 100,000 people a day, and we had number of cases at one point, I think, was 35,000 cases per day. So we really were not prepared. But since then, Tests per day has gone from 100,000 to 570,000 in the last week. So in the last 2 weeks, the daily number of cases, had been up until the last 2 weeks. The number of cases had been coming down pretty sharply, despite running 5 times as many tests. So the spread of the virus is much less than the peak in April. If you look at hospitalizations in the tri-state area, New York, New Jersey, Connecticut, hospitalizations are down 94% from the peak. So amazing progress there. And deaths per day, probably the most important number of all, has dropped 74% from the peak. So another big improvement from where we were at the end of March. And the reason for the drop in deaths is, number one, there's less spread of the virus, but two, the treatments have come a long way since March. In March, the only solution for the problem of the virus we had was to shut down all activity and hope the virus goes away. And then even in the hospitals, patients with low oxygen levels, they were immediately put on ventilators. And then we later found out that that's probably the wrong strategy and does more harm than good, putting patients on ventilators too quickly. But since then, we've come a long way. We've got more options for treatments available now. Gilead's antiviral drug remdesivir was approved and has been effective in reducing hospital stays. There's convalescent plasma is being used in hospitals with good results. Doctors are prescribing anticoagulants to help with heart conditions. And then recently, the steroid dexamethasone was approved, is showing a good effect on patients and reducing death of severe COVID patients. So there's a lot more treatments available, and that's why the number of deaths has declined by 70% from the peak. And there's more to come. The most promising antibody drugs started trials in June. There's an enormous amount of data coming in the next few months, with all a large number of clinical trials taking place on treatments. And then on top of that, I think the most exciting news is on the vaccines. In March, the vaccines were just starting human trials, and there were very few of them starting human trials. And I think the consensus view was that it would take at least 12 to 18 months from that point to have a vaccine in full production and being available to the general public. I think that timeline has shortened considerably since then. So at the end of June, we now have 172 vaccines in development worldwide. 13 of them are already in human trials. There's going to be a lot of trial data coming out in the next few months. Just in the last 2 days, yesterday we had Inovio release phase 1 results that showed their vaccine was safe and effective. And then today it was Pfizer had phase 1 results of one of their vaccines, one of 4 they're developing, that showed it was safe and effective at producing antibodies, and those will move on to phase 2 and phase 3 trials. Now we have AstraZeneca is enrolling patients in a phase 2 and phase 3 study. Moderna is launching this month a 30,000 patient phase 3 trial on their vaccine, and the governments are helping the manufacturers of vaccines to build out manufacturing, so they can have potentially hundreds of millions of doses available as early as the fourth quarter. So quite a bit of progress from the beginning of March, where we were just starting human trials for a few vaccines. So we've come a long way for treating the virus.
Right. And again, the key is that the trends are dramatically improving. It might be bumpy. There's no way that we're not going to have more disappointments as well as more celebrations along the way. And then that gets into the next part of our market letter, which is our outlook. So we, at this point, we're thinking that between now and year end, I could even say now in the next 12 months, we're going to continue to see upward trending, right? I think we'd be fools. I say this all the time. I think we'd be fools to bet against upward trending over time. But we're going to see upward trending with tremendous choppiness. And I've joked that choppiness might even mean 40-foot waves. But there are big issues ahead of us. And right now, the 2 big issues that are really overarching are the election and the virus. I think the nice thing about both of those is without doubt, there will be clarity on both of those by year end. By year end, we're going to know if we hit a second wave on the virus. We're going to know what vaccines look like. We're going to know what the targeted versus, semi-reopening, partial reopening. We're going to have a lot more information between now and year end, and that'll be meaningful. So that's part of it. With the election, one of the things that I've been thinking about is how ahead of every election, you always, the market, all of us, we climb a wall of worry. And there's usually a lot of anxiety that starts in the market and in investors that starts to lead up to the election. And I think that's because ahead of an election, 100% of people are worried that they might not have the outcome that they want. And then usually after the election, about half the people are happy with the outcome and cheering, and the other half are crying. But after the election, everybody knows what it is. And one of the conversations we've been having a lot is with clients is if it's a Democratic sweep, so they take presidency, Senate, and House, is that really bad for the markets? I think the conventional wisdom has been that it should be, but the reality is if you look at past times that's happened, not necessarily. We think that it's likely that whether we get a Dem sweep or a split Congress, or Trump gets another term, which according to the election betting odds right now is increasingly unlikely. I think that wherever it goes, in the shorter and longer term, we will all see increased tax rates, right? We have a big bill and we're going to need to pay for that. But the bottom line is there will be clarity by year end. And what we know from human nature and the American society and capitalism, the way it works here, and our tenacity is that once we know what we have to work with, we always find a way. We collectively, always find a way to thrive and grow. So I don't doubt that would not happen in the future. From a regulatory perspective, one of the things that we've been listening to is usually when there's kind of an anti-business sentiment by an administration or Congress, usually people think banks and healthcare are the most likely to be affected. I'm curious to see this time if that's different, in that the healthcare industry has really bailed us out and saved us from this pandemic being a lot worse, and banks aren't the culprit, and banks actually have been a major player in helping get through this situation. So I wouldn't be too surprised if the next version of overregulation, or I shouldn't say overregulation, the next version of regulation is actually focused on things like Facebook or Amazon or the big mega cap tech companies. Who knows? But it's just something that we're thinking about. Let's see.
Can I just add that one point is that before every presidential election, there's always this fear that the new administration or whoever takes over, if there's a change of administration, will disrupt growth and kill the economy. And that's been true. I remember 4 years ago, Jenny and I were writing a letter at 2 a.m. to clients about how Trump may not be, from the economic perspective, may not be that bad for the economy. As we're writing that as Asian markets were down 10%, U.S. futures were plunging, and then I think back to the fears, ahead of when before Obama took office, there were some concerns about him derailing growth, and for back to the even before Clinton took over, there were some concerns that his policies would be disruptive to growth, which turned out to be completely wrong. But every administration change, there's this fear, because it's the fear of the unknown. You don't know what's going to happen. But so if Biden won, there's a likelihood that taxes would go up, but there's offsets too. There's perhaps we get more clarity on foreign policy and trade, and that can companies with greater clarity and less volatility and on policy concerns would be more likely to invest and increase investment. So there's offsets, but we don't think that whatever the change is, that it would derail the economic growth of the United States.
Right, and that brings up another good point too, which is that we don't invest accordingly. We don't invest the portfolios according to who we think is going to take office, or what the Congress looks like. We invest in companies that should thrive and withstand any administration. So as you think about what we're doing, politics isn't really playing a role. Maybe if we were investing in healthcare and there was obvious major regulation coming, like maybe that would have been, maybe that would affect our investment decision. But right now, we're not investing based on the fact that it looks like Biden is leading by about 20% in the election betting odds polls. That's not part of the investment conversation as we make new investments. So on that, I will touch on the portfolio. Since we last spoke, I added national retail property to the portfolio. That was obviously the last new move of the quarter. National retail property is a terrific business. In fact, I think I added it shortly after, within about 24 hours after our call from 2 weeks ago. The research was all teed up and I was just waiting for the right price. But this is a company that we initially bought in 2010, owned until May of last year. We know it really well. They own things like they own the standalone convenience stores, and then they lease it back to the organization that's operating the convenience stores. They own car washes and movie theaters. Not many movie theaters, don't be too concerned there. They own fast food restaurants and just all sorts of standalone businesses. They don't own strip malls. They don't own malls, just individual buildings. And you can look back at their history during the worst of 08-09 too, and see that they still retained 96.5, I think it was 96.4% occupancy during the worst of those times. When we were talking to the management, they said they basically could collect only 52% of rents for an entire year straight and have no problem paying all their debt, all their obligations, and the dividend without blinking. We don't think that they're going to only collect 52% of rents for a sustained period. This is a really good business. And we were psyched to be able to buy it. So just one other thing. When we initially bought it, we paid, I think, about $27 a share for it. When we sold it last year, we sold it around $54 a share. And now we're just able to reinvest at about $37 a share a couple weeks ago. Meanwhile, the earnings have grown tremendously. The dividends grown tremendously. The earnings more than cover the dividend, even in a really rough time. So we were thrilled, and it was nice to get back to investing with this company. And one of the things I write in the market letter is that Winston Churchill quote that everybody's talking about all the time now, but it's, never waste a good crisis. And I do feel like the last 4 investments that we've been able to make have been, and the increase in positions has been very much to that theme of not wasting a good crisis. So hopefully we've taken advantage of a lot of the pain that we've experienced over the last 3 and 4 months and put it to good use for long-term money making. I don't think that between now and year end, I don't expect much more change to the portfolio. Right now we're at just about 31 core positions. Maybe between now and year end, 1 to 3 new ones enter, but a lot of the transitioning work and reinvestment work is done at this point. At this point, I'm very, very happy with what we own. As I've been preparing to send out quarterly reviews, it's been really nice to see that the expected income generation for 2020 for most portfolios is exactly what it was in 2019. So usually we have a bit of growth. We're not going to have the growth in income this year, but the absolute income generated in 2020 should be what it was last year. So I'm pretty psyched to have been able to maintain that throughout all this carnage. With respect to the total market value of the portfolio, I wish we'd recovered as fast as the S&P 500. We haven't. Almost nothing has, by the way. Besides the S&P, the Russell's down significantly more. The equal weighted S&P is down significantly more. The Dow Jones is down significantly more. We're down significantly more. But again, I have no doubt that with the passage of time, we won't recover and make some nice money and bring in some nice income along the way. Greg, do you want to touch on growth and international?
Yes. First, the international. We're seeing a pretty strong economic recovery taking place in overseas. Most of the economic data is pointing to still down from the pre-virus levels, but a strong recovery from the lows of March and April. For example, Germany, May retail sales were up 14% from the previous month. In France, spending on consumer goods is up 37%. And we see this across Asia and Europe, where the consumer is coming back very quickly. Still below pre-crisis levels, but the recovery is taking hold. We think the international markets are well positioned for the next 6 months. I think one of the key differences between international markets and the U.S. is in how they're handling the virus. We've become very comfortable as a country in having a pretty large outbreak continue with the virus. So when cases were down to 20,000 per day, policymakers in the U.S. were fairly comfortable with that level and continued to reopen the economy. And even with cases now 40,000 a day, there's not much alarm from the federal government, and most states are still, even though some states are pulling back in the reopening, many states are continuing ahead with it, even though we have 40,000 cases a day. Compare that to many international markets where they're taking a much stricter stance on the virus and having much better results as a result. For example, Tokyo in Japan, when Tokyo has more than 50 cases per day, they shut down. Just 50, not 50,000. 50. Melbourne just shut down in Australia after having 70 cases a day. They were quite concerned about an outbreak starting. Beijing shut down a few weeks ago. They were having about 100 cases a day. So much more stricter policies in terms of keeping the virus under control. And what that means is that they're much better prepared for a potential outbreak in the fall. And they could potentially have a quicker economic recovery relative to the US. And they're going to be in a much better position to implement fiscal policies because they're spending less on subsidizing unemployed workers. Unemployment rates are much lower outside the US, and the budget deficits are much lower. So they're going to be in a better position to enact fiscal policies. And while we're concerned about tax hikes in the US, I think many overseas economies are going to be in a position to potentially cut taxes to try to stimulate growth. So I think international is well positioned, at least for the next 6 months, relative to the United States. No changes to the portfolio in international. As far as growth, we think the growth portfolio is well positioned for the current environment. All the companies in the portfolio have positive free cash flow, or expected to have positive free cash flow in the second half of the year. So they're in good shape. But they're also, because it's a growth portfolio, there's a lot of sensitivity to economic growth. So if we do get a vaccine, or if we do get a better treatment, and the economic recovery continues and 2021 starts to look better, that should benefit the companies in the portfolio. We bought Intel and Thermo Fisher during the quarter. We haven't added any new positions in the last 2 weeks. The tech companies in the portfolio have performed very well, but they're becoming more expensive. So we think the best opportunities in the growth portfolio may be outside the tech sector. So we may see some rotation in the coming months out of some tech companies that have become relatively expensive into opportunities outside the tech sector. And that's the growth portfolio.
Great, thanks. With that, a little bit of housekeeping. So it's almost time for quarterly reviews to start. I'll get those out to you in the next 2 weeks. If you want it electronically instead of hard copy, let me know. Otherwise, we will go back to the way we were doing it prior to last quarter. Some of you get hard copy, some of you get electronic. Whatever works for you works for us. So just let us know. Market letter should be out, I think, early next week. We'll probably start the final edits tomorrow. So hopefully that goes smoothly. It's usually quite a contentious process here, but I think that's why we get a decent end result. Anyway, with that, I will open it up to questions. If you have questions and you're on the phone, you can hit *6 to take yourself off mute, or if you are on the computer, you can just unmute yourself with your little, I see who unmuted himself quickly. So does anyone have questions? Eric?
I'm willing to let somebody else go first.
No, it's fine. But seriously, does anyone have questions? Take it away.
Okay. So I'm looking at this chart in front of me where what I usually do is S&P, equal weighted and regular, and then the NASDAQ. And it's sort of like the difference between the cool kids in the NASDAQ and, well, everybody else seems to be pretty stark. Now, again, are we basically just waiting for a vaccine effectively for everybody else other than the companies that are making their money completely online?
I think the question's bigger than that, and it's something that we've been exploring a lot lately. So I think you could almost say like NASDAQ and everyone else, or you could say the top 5 and everyone else. And the top 5 are Facebook, Amazon, Apple, Microsoft, Google. So one of the projects that we've been working on, and I'm excited that you asked this question because it's not the direct answer, but it's something that I've been enjoying thinking about and wanting to talk about and trying to figure out what the right format to talk about it is, because I literally could go on for the next hour and a half and you'd all fall asleep. But I might write it, we might try and write it up in a paper. But one of the things that we looked at is if you look at the top 5 companies in the S&P 500, so the 5 I just stated, they make up 20%, and everybody knows this, of the total weighting of the S&P 500, total market capitalization. The last time that happened was in 2000, at the very peak of the dot-com boom. And we went back and we looked at what those companies were. And I think for me, at least, they surprised me. They weren't as crazy dot-com boomers as I expected, but they were they were Walmart, Microsoft, Cisco, Intel, and Exxon. And that really surprised me. So what happened in the 10 years following that peak of those 5 taking up the same amount of weight in the S&P 500 that the current 5 take up is that over the next decade, they underperformed the S&P 500 by 36%. And one of the things that I think is interesting is that back then, you could make the same argument for Walmart that people tend to make now for Amazon, which is it's too big, it's taking over everything, there will be no competition. So as I've thought about how and why that changes, I've looked at it 2 ways. One of the things we did for fun, and Greg, if you think I'm getting off track, just jump in here. Don't be shy. Greg's my handler right now. But one of the things we did was we said, okay, let's look at the share price growth of those 5 and the share price growth of everyone else, right? The cool kids and everyone else. And what we found was that those 5 over the last 5 years have grown at 28% a year. And we're not talking about revenue growth, not talking about earnings growth, just the share price. Everyone else has grown at about 7%. The valuations of those companies, in large part, assume that they continue to grow at the rate they're growing at. If that were to happen, I've got this on another screen, but in 5 years, I think it is, they would make up 40% of the S&P 500. And in 7 years, they would make up, I don't remember if it's 7 or 10, but they would make up 60% of the S&P 500. That's obviously unsustainable. Then I ask myself, what changes that, right? If these are great companies, and by the way, they are great companies, Apple, Amazon, Google, Microsoft, they're great companies. But the reality is if we think back over the history of humanity, whenever one entity starts to grab such a large piece of the pie, something happens. And I have no idea what it is. Competition comes in. There's too much money being made by 5 for competition not to come in somehow, or government regulation to come in and break that party up. So I don't know what happens, but I'm quite certain that something starts to give on closing that divide. Separately, with respect to our portfolio, which is certainly not the cool kids right now, one of the things that we've worked on in the past week, Greg really drove this project, so if you want to jump in and override me, please do. But one of the things we've looked at is what the history of the earnings growth has been in the portfolio, and the multiple, as well as the payout ratio. So over the past, what's it been now, 14 years that I've been managing this, the earnings have grown surprisingly quickly and surprisingly consistently. The payout ratio of the portfolio has gone down. So there's actually more coverage of the dividend over time. And the price to earnings multiple has gone down. So what you see is the divide between the haves and the have-nots just on multiple ascribed, despite the fact that the have-nots are performing very well and becoming stronger and better companies, their multiple relative to that, the very top has been pulled in different directions. So if you look at any chart too that shows, the growth of the growth stocks versus value, the multiple has been wider and wider. I don't know exactly what the catalyst is, but I am certain that something gives on that. And I bet you it gives in reasonably short order. I don't know if short order is 2 years or 12 months, but at 20% and heading dramatically higher quickly, it seems like something's got to give to rationalize that. Okay, sorry for this super long-winded. Anyone else got questions? Sorry, I know I sound cheesy when I say that. Does anyone else have a question? Would anyone else like to ask a question?
I don't have a question, but I had seen some research recently that said whenever both parties whenever a party controls both houses of Congress, that the market is up at least 12% per each year during the administration. It doesn't matter Democrat or Republican. Republican was like 2 points higher, but still significant returns because they get things done. They're not spending all the time fighting with each other.
That's really interesting. Greg, have you seen that?
I have not seen that because the conventional wisdom is that the best thing for government is to have a divided government that would do less, that the markets would like less regulation. But if that's true, and considering that according to the betting odds, that it favors for a Democrat sweep, and I know we're still 5 months away, 4 months away from an election, but if that's true and the Democrats do sweep the elections, then that would be good.
Yeah, but you know what? I think actually, I'm trying to remember, I had forgotten about that work, but I think I have seen it, and I wonder if it's a JP Morgan piece. So Gary, thanks so much for reminding me of that, and we'll definitely pull it up, and maybe I'll even use it in the quarterly letter to say, look, don't be too afraid. For those of you who think it's going to be a Dem sweep and are really worried about it, here's the reality. So thank you so much for the reminder on that.
It actually does the best when they're on holiday. If we could send them on holiday, the market would go through the roof.
That's funny. That's really funny. All right. Would anyone else like to ask a question? I'll check my phone in case there's emails too. I love the questions. Sadly, no email questions. Okay. Anyone else, or should we wrap it up? And don't be shy. We love them. Okay. Well, we're 100% available offline. So thank you for participating. We are going to try to do a little bit different format call to go over the quarterly letter. And we're going to open that up to a slightly broader group of clients. So there might be a few unfamiliar faces on, and we'll see how it goes. After that, I think I'd like to, rather than just planning to do this every 2 weeks, and if you love it and you would like me to and you feel really strongly about it, please, please, please let me know. Otherwise, I might start to play this by ear. As you all know, we've never done this before and are doing it for this extreme period. So I might play it by ear. Maybe we'll go to once a month. Maybe we'll go to ad hoc, but please let me know your feedback on it. Whatever works for you. I want to help you get through this as comfortably as you can. So don't be shy to share your thoughts. All right.
One thing, Jenny, if you validate what I thought I read, if you could just send a blast out to
You
us.
got it. You got it. Oh, and if anyone would like the link to that TED Talk by Steven Pinker, it's only 18 minutes and it's excellent, and it will make you feel better about life. So don't be shy to ask for that too. But yeah, I'll definitely send that to everyone on the call if I find it, Gary. Thank you so much for bringing it up. Okay. Bye, everyone. Enjoy your weekend.
You as well.
Happy 4th of July. I can't believe it. Holy moly. Okay. Happy 4th of July. Have a good rest of the week.
You too, Jenny. Thank you.
Bye.